Sam, it is great to have you here. Thank you for joining us on Capital and Power. And I wanted to ask you, because it's a quote that I've heard you say in the past, but it's applicable today, especially with what we're going through. And we're going to talk about all of this. But one of the things you like to point out, and correct me when I get the quote wrong, is there are opportunities when you should be buying, what is it? You should look from, go from the first to the worst. What do you mean by that?
Well, Adam, first off, it's good to talk to you. And what I do is I like to look to history. Mark Twain said that history might not repeat, but it frequently rhymes. But I also acknowledge that, like the singer of the national anthem, sometimes it forgets the words. So I start with history and then do economic, fundamental, and technical overlays to see whether it will repeat or go down a different path. But what I've typically found is that during declines of 10% or more, and this goes back to 1990, which is as far back as S&P has sector level data, that during the decline itself, not surprisingly, it's the defensive areas, consumer staples, meaning food, beverage, tobacco, as well as healthcare and utilities tend to be the better performers because, let's face it, when the going gets tough, the tough go eating, smoking, and drinking. And then the question is, well, what happens once we hit bottom? And what happens is that investors tend to rotate from the best performing sectors during the decline to the worst performing sectors and sub-industries during that decline, because many of these companies were priced to go out of business but did not. And so they represent the greatest upside potential. So going back to 1990, in that 12 months after a 10+% decline, while the S&P was up 24% on average, the three worst performing sectors gained 34%, and the 10 worst performing sub-industries jumped by 60%. Not a guarantee that it's going to work again, but it is working this time.
Well, there's that famous quote, this time it's different. It never is, or is it?
Well, that depends. That's the right answer to most financial questions is that depends. Depends on what you mean by this time it's different. I think the triggers to many of these bear markets could be different from one time to the next. You know, like when was the last time since 1962 that we had a Cuban Missile Crisis spark a 28% bear market? When was the last time since 73, 74 that OPEC shut off the gas supplies to us, and we had a 48% mega meltdown bear market? So you see what I'm getting at is that a lot of bear markets get triggered by different things. However, the reason that I continue to look to history is that there's been one thing in common during all bull and bear markets since the beginning of time, and that is human response. So if we get to a point when AI does all of the trading, maybe history won't be meaningful the way it is today, but still, I tend to defer to what has happened in the past, and I'll take anything that works 2 out of every 3 times or more.
Well, you've also pointed out, I believe, in the past that there's a bull market somewhere, even when there's a bear market in our own backyard.
Absolutely. And so you can look to that by monitoring momentum, look at it through a lens of short term, intermediate term, longer term. And so there traditionally are opportunities. There are, however, vacuum periods, if you will, like back on April 8th, when the market finally hit bottom after declining about 19% on a closing basis. We had only 1% of the 155 sub-industries in the S&P 500 trade above both their 50 and 200-day moving averages. So water utilities and healthcare distributors were the only groups that were still above those two measures. Everybody else were below, but that was an indication to us that the market had been oversold and was ready for some sort of a bounce because, in a sense, investors threw out the baby with the bathwater.
But one of the things that, and I've been watching interviews you've done on other podcasts, and I've known you from the years when I was doing this on TV, and we would talk, but you pay attention to that which it seems mainstream financial journalists don't pay attention to, things like the S&P 1500 subsectors. Why does that play such a role in your overall vision of what might be happening at a given moment in time?
Well, first off, even though you might think that the S&P 1500, which consists of the large cap 500, mid cap 400, small cap 600, you might think, well, gee, isn't that just like looking at the equal weight S&P 500? No, because 92% of the weighting of the 1500 is the S&P 500. It is a cap weighted index, but I try to represent the full US stock market, and at the same time it adds about 50 sub-industries to the overall universe when compared to the S&P 500 itself. So, I try to use a fairly broad measure to see what is happening in terms of participation. Is it broad? Is it narrow? And as a result, whether it's something that's likely to persist.
I think the question on a lot of people's mind is where are we right now? And before I ask you that, there's something you pointed out in a previous interview, which is it's very good because you talk about, quote, the heroes in previous bull markets become the villains in the bear market. Talk to me about that because I'm immediately thinking of the Mag 7. Is that correct in what I'm trying to figure out here?
Yes, I think that the heroes in the prior bull market then become the villains because they have the greatest profit that investors want to retain. And so frequently they will push up those winning stocks, mainly because there's a new theme, a new trend, earnings growth potential, or whatever the macro backdrops are that are propelling these issues. And so as a result, they're probably trading well above their 200-day moving average and also well above the average difference with their 200-day moving average. Once the market does decide it's time to take some profits, they're going to take profits where they have the greatest amount of profits. And then they end up being, the proof of the old adage that a bull market takes the stairs, but a bear market takes the elevator because investors want to retain as much of that profit as possible.
And now I'm going to ask you the question, which I think people watching are all speculating upon. Where are we in the cycle right now?
Well, we're in the third year of this bull market. And when you think of child rearing, you say the terrible twos. But when you think of bull markets, think of the traumatic threes. There have been 11 bull markets since World War II that celebrated their second birthday. 12 months later, those 11 posted an average increase of only about 2%. Take out the three bull markets that did not make it to their third birthday, you're still only talking about a 5% gain. So historically, the third year is a very challenging year for the market. Also, what we find is that wanting is more profitable than having. That in the 12 months between the last rate hike and the first rate cut, the S&P gained about 19% on average, whereas 12 months after the first rate cut, the market was up again by less than 5%, with half of those observations being negative because the Fed waited too long to start cutting interest rates. First year of the presidential cycle, when you have a Republican in office, the average drawdown is about 15.5%. Versus about 10.5% for Democrats. Maybe that's simply because of how the calendar fell, but we basically saw that again this year as well. So volatility tends to be a major factor within the third year. So here we are. The S&P declined almost 19%, got back up to its 200-day moving average. And the question is, do we have more upside or is there a potential fake out? Well, there is a potential fake out because 2 out of every 3 bull markets, or I should say bear markets, that ended up going back to the moving average, then turned around and set an even lower low. The NASDAQ just recently scored a 20% advance off of the April 8th low. And you could say, oh, we're in a brand new bull market. Well, 50% of all bear markets had at least one fake out of 20%, with the bear market of 2000 through '02 scoring 5 before the market finally continued to move higher. So history says you have to be very, very careful at this point. But that's when I lean toward our Lowry technical research arm. Lowry is a business that's been in existence since the late 1930s. They look to shorter term indicators, in terms of supply, demand, upward thrusts, things like that. And so they have provided me with the confidence that at least in the near term, we still have more upside potential.
So I'm going to break down what you just said, and forgive me because you've got almost 40 years plus experience in this industry. But what I heard, what stood out to me, and I've heard you point these issues out in another podcast, but what made my heart stop was when we have these bear markets, then we get a drop, but then we come back, it's short-lived, and then you get the drop again. Am I getting that correct? Because I'm feeling right now people are thinking we're back. The market is gangbusters. Your most recent note, back in the black. But to me, what I'm hearing is warning, warning, danger, Will Robinson.
Yes. Well, at least we watched the same shows growing up. But you're absolutely right. It doesn't mean that, I'm telling people to sell into this rally. Just be very careful because, we have had exactly 64% of the time in which we declined by 10% or more. But then of the bear markets since World War II, a majority of them did indeed recapture their 200-day moving average, only to be like a whale, take a breath, and then turn around and dive even more deeply than we had before. So that is a possibility. Because this is or was a manufactured correction, that's why I think you could say you might not want to rely on history 100% of the time or 100% of the way in this one, but just be very careful that if we don't get an agreement between ourselves and China during this 90-day cooling off period, we could turn right around. Bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. If we end up with a bear market without recession, average decline is 28%. Bear market with recession, the average decline is 35%.
In fact, you crunched the numbers. I'm glad you brought up the R word, the fearful R word, recession, because Jamie Dimon is running around, saying there's a 50% chance. And I was laughing when I heard that. I said, well, yeah, I mean, it's like a broken clock's going to be correct twice, a day. But when I hear Jamie Dimon, who clearly has his fingers on the pulse of the economy, saying, beware, folks, and also saying a lot of people are underestimating the risks to this market. Are you in line with what he's saying? Or are you just saying, look, history shows us what happens in a recession, but at this moment, you can't know until we're in it?
Yeah, what I'm saying is that tariffs could end up being the trigger that throw us into recession. So that's why it's very important to monitor what is going on and whether this is it rhetoric or reality as it comes to the tariffs? And do we really want to make the other side scream uncle? Or are we simply trying to get a better trade deal? And will we be willing to back off if it looks as if we truly are headed for recession? The president said, no, we might need to fall into recession for us to get what we are looking for. And if that's the case, unfortunately, the National Bureau of Economic Research, they don't tell us we're in recession until 7 months after the recession actually started. That is their track record. The S&P 500 has anticipated recessions by an average of 6 months. So if that is the case, well, then maybe the recession would start in August if this is a decline in advance of a recession. But the NBER is probably not going to tell us we're in recession until the early part of 2026. So that could be a challenge in and of itself.
So let's break this down, because there's also a signal once they do declare recession as a time for people to get back in. But right now, I mean, the stock market has been accurate in predicting what's the quote, 4 of the last 10 recessions?
9 of the last 5 recessions. That's right.
Right. 9 of the last 5 recessions. When I hear this kind of discussion about recession, help me understand the flaws in my thesis, is right now we are back in the black, as your most recent note talks about. And for most people, we're not perhaps totally recovered from Liberation Day and the fall that was manufactured, but you're close. So if you're worried about recession starting in August and because we have this uncertainty with tariffs, would now be the time for someone like me, a risk averse conservative investor, to maybe put some money to the side, take some profits off the table and wait to see what happens? Would that be a flawed decision, or would that be a overly cautious decision?
I think it would certainly be a cautious decision. And if you're someone like myself who is so cautious he wears a belt and suspenders, then maybe that is something you might want to do. You could embrace another strategy where, interestingly, not surprisingly, technology has been the best performing sector since 1990. So you think of the poster child for growth and volatility. Yeah, that's technology. Yet, when you think of, well, what's the poster child for stability? It could be consumer staples, food, beverage, tobacco. Yet, interestingly enough, a portfolio of 50% tech, 50% staples rebalanced annually gave you 95% of the return of tech, but with 40% less volatility. So if you've are someone who has done quite well with technology and you're thinking, maybe I want to back off, I don't want to be selling out entirely because that would be timing the market, but maybe at least sort of add a little bit of defensiveness to my portfolio, you could think about doing some of that kind of trading. But in terms of short term, we are not a short term trading firm. We do use our Lowry arm to sort of help us to feel as if we're on the right track. But our analysts look more 9 to 12 months down the road when they make their buy, hold, and sell recommendations.
Before I jump into your note and ask you a question about the point to get back in with the recession, this is a very rudimentary question, but financial journalists and analysts talk about short-term, long-term outlook, but I've never heard any one of them define or quantify what they mean by long-term. Do they mean 6 months? Do they mean a year? Do they mean 5 years? For the average investor, and that's how I would describe myself and a lot of the people I think who are watching, how should we define short-term, long-term?
Well, maybe you could think of it as how long would it take to get back to break even from a decline that you just endured? We have had about 65 pullbacks, which are declines of 5 to 10%. And in my definition, you have to recoup everything before you can say that you're out of a pullback. Well, a pullback took about 1 month to go from peak to trough, and then only about a month and a half to get back to break even. So if you're thinking about, okay, that makes it about 3 months, 3 to 4 months, anything between now and 3 or 4 months, that to me would be short term. We've had about 25 corrections or declines of 10 to 20%. It's taken us 4 months to go from peak to trough and an average of only 4 months to get back to break even. So I would say you're dealing intermediate term with something that's, beyond the 4 months going out to 8 months or maybe even 12 months. But then when you look to bear markets, and we've had 14 of them since World War II, most of them being what I call garden variety bear months, 20 to 40% declines. On average, it's taken only 13 months to get back to break even. So 13 months, I think, would be a good starting point for a longer term. And then the real question is, yeah, but how long would I have to wait to guarantee that I never have a decline in my portfolio? Well, going back to World War II, you would be looking at about 12 years. So looking at 12 months and then moving ahead by 1 month and then doing the analysis. So looking at every 12-month period rolling from World War II, we've needed to be invested a full 12 years in order for the S&P to never have posted a decline on a total return basis.
Okay, so here's why what you just said and then what we said earlier in this discussion puts a little caution into my heart as someone who's looking at retirement within the next, 7 to 15 years. You just gave me that 12-year metric. And yet, if the time to buy is when there's blood in the water and we're in a recession, and let's assume that all comes about and then early 2026 is when you should get back in, what I'm hearing you say for a lot of us is that you're going to have to stay in for another 12 to get back to where you need to be.
Since World War II, we have had 3 mega meltdown bear markets or declines of 40% or more. And the average has been 5 months to get back to break even. It's, when you really go back over a long period, and you never want to have a decline in every one of those monthly observations that you have to go back 12 years. But I would tend to say that if you have a time horizon of 5 years or longer, you're probably better off being invested in equities, because why do you invest to begin with? Because you want to defer consumption. You want to make sure that you will have enough 5, 10, 20 years from now. When I was younger, a bottle of Coca-Cola cost 10 cents. Add a zero and then do a multiplication to come up to what the cost is today for that item. So, if you're talking, Adam, about 15 years before you retire, but then again, you've got another 15 plus years in retirement. So your time horizon is not 15 years, but 30 years or longer.
But the other thing, when we talk about these time horizons, it gets back to the point of this time, that quote, this time it's different. This was a manufactured situation because of the tariffs. And yet what I hear and what I think the people watching hear is that so much is uncertain now. We're using data from World War II going forward, but at that point, the U.S. was a dominant economic power. I guess it's the early 70s where the dollar becomes the currency for international trade, which then made it cheaper in a lot of ways in the United States to conduct business. And just as consumers, other things made life easier. And that all seems to be reversed. So can we look at the past as it's not going to guarantee an outcome, but what we know from the past, will it still apply going forward?
Well, I think it will. When people talk about the US dollar and people moving away from the dollar, yes, that's something that might occur on a short-term basis. It certainly, or maybe even an intermediate term basis based on our prior definition. But in terms of, has the US lost its reserve currency status? I don't think so, because where would you go? You could say, well, the Swiss franc is the one I want to go to, but not enough people could fit into that room. It'd be like the Marx Brothers in their A Night at the Opera skit, where everybody tries to fit into that very small stateroom. There's just not enough room. Do you really want to be going to the euro? Do you want to be going to the yuan? Really, the thought is that the US dollar remains the most stable currency in the globe. So I think that also investors are opportunists. They're going to go to where attractive valuations currently sit. And if the market is going to go through a period of softening value of the US dollar, then it makes sense to look overseas. And when you look to developed international, we're trading at a double-digit discount to its average relative PE ratio, and emerging markets are a little less than that, but still fairly attractive. And if international indices have underperformed the S&P in 12 of the last 15 years, then reversion to the mean seems to be an attractive alternative at this point. And also when you look to some of the developed international areas posting higher dividend yields, if somebody is looking for more value-oriented investments that do offer a nicer dividend yield, then yes, developed international make a nice, attractive alternative at this point.
How does that play, though, to the fear reports you might see on some of the television networks about outflows from the United States of capital into international markets? I understand look, that's where the opportunity is. It should go there. But the outflow of capital would be of concern for some people who want to stay U.S. based in their investment thesis.
Well, first off, I think you have to realize why things always seem so dramatic on financial television, or even in the print or in the radio. It's if it bleeds, it leads. Adrenaline enhances memory retention. That's why we recall where we were when tragic events occurred. So essentially, what these organizations are telling you is the world is coming to an end at midnight. Tune in tomorrow to see if it really did. so that you will then be eyeballing their advertisers. So you have to, I think, take the financial media with a grain of salt, certainly in terms of emotions and creating a sense of, of sensationalism. They're doing it for a reason. But also, if there's outflows, well, yes, about 40% of the revenues for companies in the S&P 500 come from overseas operations. So in many ways, you could say that you are already exposed to international, but you could always add a little bit more because the ACWI, All Country World Index, is about 65% US, 35% international. And so, that would represent a pretty nice chunk of one's portfolio.
I want to take a breather and step back and by the way, don't forget, I made my living on those If It Leads network. So it was very good to me, but I'm no longer there. And yes, you're correct. Tune in tomorrow to find out if it was true. They're renovating, by the way, an office next door. So if you hear banging going on, I have no control over that. But stepping back and looking at your 40 years and give or take a few, what you've seen happen when the media folk are in the panic mode. Do you ever throw a fake brick or a sock or something at the TV screen?
Well, I think I do mentally, because you really sort of wonder, are you doing the people a service by getting people worried? Because what happens is that a lot of people attempt to time the market, and they might be right as to when to get out, but they are rarely correct in when to get back in. Prices lead fundamentals. So a lot of people are going to say, you know what, I'm going to wait until earnings start to turn around before I get back into the market. But unfortunately, the market has already seen much of its gains in anticipation of the earnings turning around or the situation improving. As you had mentioned about Baron Rothschild, the best time to buy is when there's blood in the street. He also added, especially when it's your own. So I find that also Americans are optimistic by nature. If you are bearish, and you're bearish and you're wrong, you're ridiculed. And if you're bearish and you're right, you're hated. So, my feeling is it's okay to be cautious because people are very willing to say, well, investing is really just like going to the casino. And I say, oh, really? If that were the case, I would love to know which casino pays the gambler 80% of the time, because that's the percentage by which we have seen a positive total return annually since World War II.
That banging noise you hear, I'm thinking maybe it's time to buy commercial real estate because they're renovating offices as people come back into this building.
Or else it's warning us that the market's going to get hammered.
Yes. I want to go back to your book, The 7 Rules of Wall Street, crash-tested investment strategies that beat the market. Now, this first came out, 2010, 2009, right?
Came out in February of 2009, and I was very happy that my preface quoted my favorite financial philosopher, Charlie Brown, who once said, I have a feeling that when my ship comes in, I'll be at the airport. So, my recommendation to readers was don't be at the airport or in cash when the market finally turns around, which it did on March 9th of 2009.
I'm going to read a few of the quotes that I pulled out of different reviews of the book, and then I want to go over some of the things in the book. Do they still hold true today? For instance, you wrote, let your winners ride, but cut your losers short. Explain how an average investor uses that as part of their strategy.
Well, first off, realizing that if a stock has done well, those people who own that stock are going to brag to their friends about how well they have done. Their friends are probably not going to do the research that they should, and they will pile onto that bandwagon. James O'Shaughnessy wrote a book in the early 1990s called What Works on Wall Street. And he said, from a momentum perspective, you want to own last year's winners. You want to own stocks with high momentum, not low momentum, because there is an awful lot of overhead resistance that investors will have to fight through before they think that the stock is worth owning once again. So I have found that whether using a 10-month moving average or a 12-month moving average, that owning those stocks, those industries, those sectors that have leadership roles, and then let's say every month reevaluating by looking back 10 months or so, that ends up being a winning portfolio about 68% of the time.
And I think you've just answered what I'm about to ask you, but let's go back to when you and I were very young. Polaroid. Polaroid would have been one of those momentum, leader stocks in the early 70s. So as Ricky Ricardo used to say, explain to me what happened. Because it would apply today to the momentum stocks.
Sure. Well, Polaroid, you could also say Timex, they did not embrace the change in technology. Polaroid did not go to digital. Well, ditto for Timex. It took a licking as a result because it did not move to digital. So that's why if you are going to use a momentum-based portfolio approach, that you want to monitor and make sure that, let's say at the end of every month, you look back 10 months and you say, which sectors are doing the best, which are doing the worst. By owning the top three in equal proportions, you then wait until the end of the next month. You look back 10 months. Okay, which are the top three? And then you either make a change in one or two of them, or you make no change. You let your winners ride. But by monitoring it fairly frequently, in this case, monthly or maybe even every third month, every quarter, you can catch those stocks that are beginning to lose momentum because they are not keeping up with the times.
I brought up Polaroid because when I was a kid, my dad had this old Land camera, the pull up, and I think it was Dr. Land who developed the whole process. And I remember if you took one of those Polaroid snapshots, you had to shake it, and then it became the lyric, shake it like a Polaroid picture. This is something from your book. As goes January, so goes the year. Is that still true?
Absolutely. I learned that phrase from the Stock Trader's Almanac. Yale Hirsch was the originator. His son Jeff is now the editor. I find that January is a very good month to get a feeling for what will happen for the rest of the year, because if investors are willing to commit their money early in the year, they have high hopes for that full calendar year. Actually, it gave me the incentive to become bullish in the beginning of 2023. Even after the S&P fell by 19.4% in 2022, because we then had a positive January. Whenever that had happened since World War II, we had a down year followed by an up January. The market was higher 92% of the time and was up about 20% on average. You add to that the fact that we did not have a low in the first quarter that undercut the prior December low, and with those three aspects, prior lower year, up January, and a Q1 low that did not undercut the prior December low, the market was never down in that full calendar year, and the average gain was about 25%, which is essentially what we got in 2023. So I find the as goes January to be very helpful in predicting the trend for the entire year.
When we talk about this data, you have just given us over the last, 20, 30 minutes, a whole bunch of data, which I realize does not guarantee next outcome. However, if you're a numbers person, the data is very rich. And yet, investors again and again and again seem to dismiss that kind of data. Is it emotion? Is it greed? Is it I want to keep up with my buddy who did really well on his stock and I think they're doing better than me? What drives the inability to use the data to your advantage?
Well, I think it is because people realize that today is very different than 10 years ago, 20 or 40 years ago. I think history is very important because I had said before, you still have individuals, highly emotional people who are making the decisions to trade in and out. And I like to say that in this day and age of instant information, I can experience both fear and greed at the exact same moment. So, like, what do you do? So I say that, I start with history, but I do find that it can be still very, very helpful. And history itself shows that in terms of the performance of adhering to such a strategy can be quite helpful. I also teach a class down at Wharton during the Securities Industry Institute, usually in early March of every year. And that class is called Using Stock Market History as Virtual Valium. So, in other words, by understanding how the market moves and understanding history can probably help you sleep better at night.
I'm feeling optimistic. I don't think they make Valium anymore, do they? Um, I've got to ask you this. Don't fight the Fed. I repeated that line when I was covering the Fed as a reporter. Everybody on TV or in the financial journalism world repeats it. Even people who aren't in the industry repeat it. Where did that line come from? And was it only after the safeguards of protecting the independence of the Fed after the Nixon administration, or does it predate that?
I'm guessing that it predated that. Well, the Fed, it had to have been after 1912. Let's put it that way.
Yeah.
Uh, but it's one of those quotes that probably has been lost in time, but it does certainly make sense. That essentially, think about it. Why do people buy stock? Because they want a cut of the action. Okay, what is the action? The action is earnings. And how do you get paid back as an investor for those earnings? Either price advance or a dividend payout or both. And knowing, however, that you are dealing with millions and millions of fellow investors who are, I like to say that they are no better than hyperactive first graders playing musical chairs, always trying to out anticipate the other. Then, in a sense, you have to realize that you're going to have to make some guesses about where the market is headed. And one of the most important aspects of deciding if a stock is expensive or cheap is, well, what's the cost to own that stock? And usually it's in the form of an interest rate because a lot of people borrow money in order to buy that stock. So the higher the interest rate, the lower the intrinsic value and vice versa. So if the Fed is lowering interest rates and therefore making it more affordable for people to buy into the stock market, or to buy anything else that will add to the earnings growth of those companies, then you don't want to fight the Fed. You want to go with the flow.
So let's talk about what the Fed is doing right now. And a colleague wanted me to ask you about this. And I don't know if it's so stealth because we know it happened, but they're buying treasuries once again. What is their goal in doing that? Is it a red flag that they're worried about liquidity issues and making sure that there's money out there?
Well, I think first off, the Fed has a dual mandate of essentially keeping unemployment low and keeping inflation low. The goal for inflation is 2% year on year using the PCE, the Personal
Hmm.
Consumption Expenditure Index. There are a variety of inflationary indices, but they happen to favor the PCE. And then obviously the unemployment rate, which interestingly enough, not too long ago, most economists felt that 5% was full employment and that you really, couldn't hire the people that were unemployed at that 5% level because they had no skills to offer. But obviously that has been proven incorrect. So I think the Fed is trying to do whatever it can using whatever mechanism is available to it, either by just lowering the Fed funds rate, which is what banks will be charged by the Fed for overnight deposits, the
Sure.
discount rate, but also if they themselves are actively involved in the Treasury market, since that is traditionally run by the Treasury dealers themselves, the bond investors,
Hmm.
if they can affect the longer term rates, then that would be helpful as well because while the savings and checking accounts might be affected by the Fed funds rates, auto loans, home loans, et cetera, are directed more by the 10-year note. So if
Sure.
the Fed can try to assist in the direction of both, then that's what they will try to do.
So could I accurately, or if I'm wrong, say, Adam, you're wrong. But this purchasing or getting involved in the Treasury market, were they trying to keep the 10-year from getting to 5 or the 30 from going over 5, which it did briefly recently?
I think so, because even though the average 10-year yield going back to 1953, which is as far back as the Fed offers data on yields, indicates that we were at about 5.5, 5.75 on average. I still think that the Fed would like to keep the 10-year yield below the 5% level, certainly, and probably closer to the 4% area, because recent memory would indicate that if we go above the 5% level, that's a period in which we need to worry. We saw back in 2022, both the stock and the bond market declined in price, and that is a rare occurrence. Usually it's like two ends of a seesaw. If the stock market goes down, the bond market goes up in a flight to safety. But we saw that they both went down together, which caused investors to wonder whether a 60-40 portfolio was worth it anymore, was the right technique to diversify. And so by seeing that again in 2025, because of the worry over tariffs, the impact on inflation, and the potential for recession, I think that is causing the Fed again to say, we've got to make sure that we can try to make adjustments on both the short and the longer end.
Having survived the great financial crisis in 2008, as did most of the people who are watching this, should we be concerned when they start tampering with or looking at the supplemental leverage ratio with the banks?
I would say that, I guess like I felt back in 2008, the Fed certainly knows a lot more than I do, but I think we suffered equally during that financial crisis. My assumption is that the Fed probably does know what it's doing. Maybe we're getting too deeply into my area of expertise. I do better talking about equities, but my feeling is that I think that the Fed is trying to take its time and make sure that it does not make any rash moves, does not repeat the mistakes of the 1970s, by cutting too aggressively and thereby stoking inflation once again.
Let's come back to equities. And this is a simple question, and you don't have to answer it if you don't want to. If you had $10,000, didn't matter if you lost every penny of it, what would you do with it right now?
$10,000, no worry about losing any of it. It's hard not to keep my personal discipline out of the picture, or to realize, how quickly the market does get back to break even. I would tend to say that if you've got an unlimited time horizon, you really do want to be going for growth. You want to be going to those areas such as technology, where a lot of the money, capital investment is going into the improvement, where we are looking at earnings growth that is very strong, unlike the 2000s when you had many of the embryonic tech companies that were sporting PE ratios of 60 times or higher if they even had earnings. Today technology is trading at half that level, and certainly I think is attractive for the longer term. And dare I say this, but maybe even digital currency is something that investors should be considering if they're not going to worry about losing the money. Jokingly, when people would ask me, what do I think about Bitcoin? I would say, well, I haven't bid a coin since they took silver out of it. But certainly, I think cryptocurrency is a wave of the future. The real question right now is how do you value it? Because it doesn't offer any dividends, does not offer any earnings. It's only what the next person is willing to pay for it.
The greater fool theory, in real, pure capitalistic terms. When we talk about sectors and finding that which everyone's overlooking, underperformance, what are the sectors right now, if you can share with us, that you think that might be the case? We all know tech is strong, but what are we missing?
Well, I think we're missing that, people move into those areas like I had mentioned before about gravitating toward those groups that were beaten up the most. And those that were beaten up the most during the most recent 10+% decline was communication services, consumer discretionary technology. Digging a little bit deeper, it would be such areas as independent power producers, those companies that are going to supply the power for the AI generation, semiconductors themselves, which are going to be key to the AI explosion. Believe it or not, also passenger airlines, which had been doing quite poorly, are now bouncing back quite nicely in this after decline period. So a lot of areas that I think that are, you would expect in terms of technology, in terms of powering technology, but also some of the older line areas of the business place could do fairly well also.
Yeah, I think the airline's going to be fine. I just had to buy a ticket, and I was shocked at how much it cost. Want to ask you this about tech. I remember during the great financial crisis, or just before it, doing a story about peak oil. I think oil at the time was trading at 140, 150 a barrel. It was high. And everyone was talking about peak oil. And the experts were saying, we're at peak oil. And boy, were the experts wrong. It was pure to your, a description of the media. It's doom and gloom. Tune in tomorrow to find out if the world came to an end. Well, peak oil was wrong. Now we're hearing people talk about, peak AI or peak tech. What are they missing? And is the threat from DeepSeek to the U.S. based AI growth potential, is it real, do you think?
Well, I think it is because it reminds investors that you have to watch the expenses as well as watching the growth. So you can't just ignore the fact that companies are spending millions and billions of dollars in order to do their work and R&D in terms of AI. Sooner or later, you're going to have to repay that investment. And so I think investors are now going to be focusing not on what companies are spending in the development of AI, but what companies are actually making profits from that AI. We're still very, very early. A lot of people like to make a guess as to what inning of the ball game we're in when it comes to AI. I would almost say we're still in batting practice. Because we have years, if not decades, ahead of us in terms of AI. But there will come a point fairly soon, I believe, in which companies will be valued more on the payment that they're getting from AI, not the investments that they're making in it.
If AI becomes the miracle that everyone, and I work at an AI firm, expects, why bother trading or investing? You would have an AI model that could figure it out perfectly for you and everyone would have access to it, wouldn't they?
Well, that's a question about how will AI, let's say, affect the stock market. And my thought is, well, gee, well then if we don't have any emotions, then really the market is going to advance only based on earnings. But then, since AI the code is actually written by humans, the question is, well, they might take a different tack in order to differentiate themselves from an AI competitor. And so, like I don't know if you remember any of the Star Trek episodes, but the M50, Dr. Richard Daystrom, put his own engrams into that computer, and so it thought and acted the way he did. So if that's one person who can make an influence on an AI outcome, well, then you have lots of other people who might come up with their own changes or methodologies to the how the programs work. I was
Sure.
coming up with that one word, but didn't come out. Anyway,
It's
to basically say by putting in their own personalities, maybe we will end up having AI sort of be the new emotion of the individual that could still lead to outsized gains and losses by traders.
my mom is a divorce attorney and she deals with emotion all the time. And when people ask her, what is that drives her industry, she says, oh, the client's greed and acrimony. So if they can program that into AI, we might still have the kind of markets we all understand. And as far as Star Trek, I always think of the Terry Garr episode, from years ago, but that's in reruns. Back to our discussion. And then I know I've got to keep an eye on the time. But there was some things, a friend of mine who is in the industry created a timeline, which I think is really helpful. And because a lot of us, if you're over 40, you have benefited from many of the things that my buddy put together. But for instance, in 75, he talked about May Day when the SEC abolished fixed commission rates on May 1st of 1975. Do people in your industry ever think about these milestones that literally brought about the low cost, incredible growth in wealth that we've experienced over the last 50 years?
I think most of the people in the business today thought that we always had low cost kind of investments. Maybe they might think, well, I'm glad that we have ETFs when you compare them with mutual funds because you can trade intraday with ETFs where you have to wait till the close for a mutual fund. You decide when to take profits, capital gains, etc., with an ETF, but you might buy into a mutual fund at the end of 1 year, and the only return you get is a tax bill. So most people, however, don't go back to the mid 1970s and realize that there were fixed commissions at one point. And a great lesson would be pretend you are trading 100 shares or maybe even 98 shares, an odd lot. How many people even remember what an odd lot is? What would it cost you to do that back in 1968 versus doing that today? And I think people would be very, very surprised. Very interesting, comparisons that I've lived through. In 1987, I guess the reason that I enjoyed experiencing it from a historical perspective was I had no money. So as a result, I was not losing anything. But at the same time, it really only took us months to get back to break even from that 3-month bear market.
It's funny you bring up the 80s because everyone talks about Paul Volcker and interest rates back then. And what I think about when I hear interest rates is like, look, I love the low interest rate environment, and it certainly made equities, it helped build our wealth across the country. And yet when I hear people complaining about interest rates, I'm thinking, our parents, it was worse in the 80s, and a mortgage around 7 or 8% was pretty standard. And so if we go back to that kind of normal world, how does that play into what kind of stock market or equity performance we could expect? Because we've been gangbusters since, 87 and the recovery after that fall.
Sure. Well, if you go back to World War II, the average annual return for the S&P 500, depending on whether you include dividends or not, was less than 10%, 8+%. Whereas if you look to the total return annually for the S&P since, let's say, 1990, you're dealing with 11.5%. Just do a rolling 10-year compound annual growth rate, and you will see a sine curve that had peaked in 1929, that peaked in 1969, that peaked in 1999. So it seemed fairly rhythmic. And we recently saw a peak. So I would tend to say, don't expect a big sell-off, but I would also not expect to see these kind of low double-digit gains on average going forward. Also realize that interest rates do play a big part. The Fed model basically said, take the earnings for the S&P 500 divided by the 10-year yield, and you come up with a fair value for the market. Most recently, it was about 6,000 on the S&P 500. But the higher interest rates go, the lower that output becomes. So yeah, think of it as, a ball and chain. If you're trying to run in a track meet, the heavier the weight, the higher the interest rate, the slower you're going to go.
When you look back at the industry as to where we are today, my buddy pointed out, and folks, correct me if I get the data wrong, but I believe he said in the 70s, you might have had a day with 10 million shares traded. Today, it's 30 billion. And that's only possible because of online trading and the hyper speeds at which things can move. Does that blow you away? I did get the data accurate, by the way.
Yeah, I think it does blow me away to think about that, to think about how the traders on the floor in 1929 basically had to sleep at the exchange in order to make sure that they reconciled all of the trades, that the ticker tape was running several hours behind the actual trading itself. And we're dealing back then with a fraction of what we're dealing today, but it's all because of computers are able to handle that. And so I guess we are spoiled. I think about GPS and being able to go from point A to point B. As my late mother-in-law would always say to me, like, what did you do before that thing? It's like you learn to read a map. And as Yogi Berra said, I always leave extra time because I know I'm going to take a wrong turn. So you just, in a sense, accommodate for it. But we are quite spoiled today, in my opinion.
Does AAA even make trip tickets anymore? That's how old I'm going to date myself. But which is a good point. With the Rolling Stones, time is on my side. That's the greatest asset any of us have when it comes to investing. Is that accurate?
Absolutely. If Reagan was the great communicator, time is the great neutralizer of volatility. An example, I do a lot of financial literacy volunteering. I'm a board member emeritus of Working in Support of Education, also known as WISE. And I teach a class, and one of the examples that I use is, let's say you have an individual who puts $1,000 a year into the stock market for 8 years. Then the next individual puts $1,000 into the stock market from year 9 to year 30, and they both have exactly the same annual rates of return. Who ends up with more money? And the answer is the first person, even though they only put in 8,000 and the second one put in 22,000. It's essentially because of compound interest. That if you start early, it's like vote often and early, invest often and early, and you'll let compound interest do most of the work for you.
So I'm going to start to wrap up, and I've got one last question for you, which won't be a curveball. But when we talk about all of these different issues and where people should be looking forward, earlier in the discussion, we talked about the volatility and the potential for the tariff situation to come back to bite us again. Is the tariff uncertainty the greatest greatest threat we're facing, or is there something else that you're paying attention to that we need to know about?
Well, I think the greatest threat, at least to a person's portfolio and net worth, is recession. And the real question is, what could throw us into a recession? And certainly we could find that the tariff war, the trade war, if it gets out of hand, could certainly do that, not only for a recession in the U.S., but around the globe. And as the old saying goes, when the U.S. sneezes, the rest of the world catches cold. If we have some problems, then chances are the rest of the world will have problems as well. If we find that the 10-year yield remains stubbornly high because inflation is remaining stubbornly high, whether that's as a result of tariffs or some other reason, that could act as a brake on the growth of the stock market and the improvement in one's portfolio. So unfortunately, there are an awful lot of variables that go into investing, that go into cycles of the market. Probably the most important thing, however, is interest rates. If I had to pick one item to monitor and whether that will help or hurt the returns of my portfolio, it would be interest rates.
And last question for you. This is the easiest one, or maybe not. Why do you do this job? What is the payoff for you?
Well, I'm a numbers nerd. I enjoy crunching the numbers. First off, I find it to be therapeutic. I'm also a teacher at heart. I graduated from Muhlenberg College in Allentown, Pennsylvania. My degree was in history and education. And I feel as if I have the opportunity to educate investors. And so I do all this research. I write these reports because I want to share what knowledge I have. The book, The 7 Rules of Wall Street, I confess that the best bit of investment advice I ever got came from Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." So my limitations are I am overly emotional, and I figured other people are that way as well. So if I can share with them some research that I have done, rules that you can apply when making investment decisions, that can help you sleep better at night and at the same time allow your portfolio to grow because you have extracted your emotions from the equation.